Benjamin Graham was a British-born American economist, professor, and investor. He is known as the father of value investing and wrote some of the most widely used financial books. One of those is The Intelligent Investor. In this book, Graham presented an investment strategy that is still used even today. Graham even mentored some of the brightest investors we have today, like Warren Buffett, who is now one of the wealthiest people in the world. In this video, we will discuss some of the greatest lessons we can learn from Graham's book. Even Warren referred to this as by far the best book on investing ever written. So stay tuned because we will discuss the 5 most important lessons that you can also apply in your investing journey today. So make sure to watch this video to the end. This is Financial Intellect, where we promote that to be finance savvy, we are your buddy. Now let's get right into the video. Lesson number 1. Look out for Mr. Market. Think about this. You invested $1,000 to own a part of a certain business, and every single day, a certain Mr. Market comes to you just to talk about his opinion on how much the business is worth and your corresponding investment. Every time, he also asks you if he could buy your share, and sometimes he will also offer you to buy another share. In reality, however, you know that Mr. Market was actually telling you lies. For example, he told you in February this year that the value of your share was $3,000, and only 1 year later, he thought it was worth only $600, even though the profit of the company increased by 60%. Now, would you believe Mr. Market? Should you let his opinions influence your decision and your business's worth? Of course not. Graham firmly believed in treating stock as ownership in a business, not just a ticker symbol with a price tag. Mr. Market does not know this. He is irrational, so he jumps to everything he thinks is an opportunity. Graham believes, in investing, one should have the intention to hold the stock for a considerable length of time, regardless of the fluctuating prices in the market. It is normal for the market to be over-optimistic and too pessimistic from time to time. Do not let this influence you. Instead, just see it as a business opportunity where you get to deal with a person who has no idea of what he's doing. Lesson number 2. Investing as a passive investor. According to Graham, there are 2 types of investors, the passive investor and the active investor. The passive investor practices a defensive strategy in investing. He creates a portfolio with a mixture of stocks and bonds. If you are a passive investor, just remember though that the amount you invest per asset category should depend on the current difference in the average yield of stocks versus bonds. So instead, try to invest in a fixed amount at regular intervals. This process is called dollar cost averaging, and this can be a good strategy because avoiding a one-time buy-in will protect you from any loss in case you bought at the wrong time. For a stock portfolio, the passive investor should aim for the following. 1. A diversified portfolio. Do not concentrate your investment on just one company and in just one industry. 2. Large companies. Graham believes that this generates more than $100 million in yearly sales. 3. Conservatively financed companies. These companies offer a current ratio of at least 200%, which means that their current assets are bigger than their current liabilities. 4. Companies offering dividends to shareholders for at least 20 years. 5. Companies with no deficit in earnings in the last 10 years. 6. Companies with at least 33% earnings growth in the last 10 years, which means that its growth is 2.9% annually. 7. Companies that do not overpay assets. Its stock price should not be higher than its net asset value. 8. Companies that do not overpay for earnings. If you are already satisfied with the returns from your current investments, then you only need these first 2 lessons. But if you want to earn more, then let's proceed to the next lesson. Lesson number 3. Investing as an active investor. Being an active investor isn't as easy as it sounds. An active investor is patient, disciplined, eager to learn, and devotes a lot of time investing just to beat the market. Unfortunately, not many investors are like this, so many fall victims to Mr. Market. Investing your money in companies that are priced too high can be costly as well. Remember, The profits of these companies are finite, so the price you should be willing to pay should also be finite. That's what an intelligent investor would do. Price is an important consideration for an active investor. He knows that the market tends to overvalue and undervalue some prices of stocks, so he avoids these so-called growth stocks as much as possible. The reason? It's because this investment strategy puts more emphasis on future earnings, and we all know that future earnings are less reliable than current valuations. On the other hand, if you invest in a company that is valued lower than its net working capital, you are basically paying nothing for all its fixed assets. And these companies are actually proven to be more profitable according to Graham. But it's rare to encounter these types of companies now, unless during tough bear markets. Graham suggests that active investors must also utilize other methods of finding investments. Just like the passive investor, he should aim for stocks that show lower price tendencies as well, and he should also diversify his portfolio as well. He should also know how to study annual financial reports because this can be useful in analyzing companies. If you want to know more about how to read financial reports, we've created a separate video for that, so you might want to check it out. Now, before we move on to the next lesson, if you love content such as this, kindly give this video a like, subscribe to the channel, and turn on the notification bell so that you will know when we've posted new videos. We'd love to be part of your financial journey. Now let's continue with the next lesson. Lesson number 4. Put importance on margin of safety. As an investor, you are always at risk of being wrong. You cannot eliminate that. You can, however, minimize that risk. To do that, you just have to insist on the margin of safety in every investment you make. Remember, the price and value of the company are not always the same. When the price of the company is only 2/3 of its calculated value, you may have found a company that has a good margin of safety. A formula you can use to calculate the value of a company with enough margin of safety is this. Value equals current normal earnings times 8.5 plus 2 times expected annual growth rate. A good company to invest in should have a growth rate equal to the expected yearly growth of earnings for the next 7 to 10 years. Lesson number 5. Risks do not always mean rewards. One academic theory suggests that the degree of risk an investor is willing to accept must be proportional to the rate of return he can expect. Risk, therefore, should be measured depending on the possible returns on investment. Graham does not agree with this theory. Instead, he firmly believes that the value of assets and price are actually disconnected. An investor must expect a return corresponding to the time and effort he is willing to put into investing. This is why passive investors can expect minimum returns, while active investors can also expect higher returns. Let's take, for example, an instance where you go to a billiard bar. A man suddenly challenges you to shoot 2 billiard balls in just one shot. And if you can do so, he will give you $5,000 in exchange. At first, you refused, but the man revised his offer and said you can have 2 tries instead. This example represented the academic theory I've mentioned previously, which demands higher potential reward just because you took a higher risk. It may sound logical, but the stock market does not have to be like that. Again, remember that price and value are not the same. If you buy a company at 50 cents per dollar, you have low risk and a great potential for returns. And if you can find another one where you can buy 30 cents on the dollar, then this presents better rewards and even lower risk. And those are the 5 lessons we can learn from Benjamin Graham's The Intelligent Investor. What do you think of Graham's lessons? Do you think they are still applicable today, even though the book was first published decades ago? Let us know in the comment section below. We'd love to hear your thoughts on this. And with that, thank you very much for watching. If you like what you've watched, stay tuned for more videos. Bye, financial buddies!